Assalamualaikum and hi everyone. Welcome back to my channel. I am Yusna Liza Hamid. Today we are going to learn how to prepare the consolidated statement of financial position on subsequent date. And this is dealing with MFRS 10 and how do we apply it in the preparation of consolidated statement of financial position, as well as also the guidance coming from MFRS 3 business combination. Right. Before we start, the focus of today's session is actually to show how do we do the accounting treatment should we have also acquired the investment in or we have investment in preference shares and loan capital or the debentures in the subsidiaries. So I'm putting ourselves here as the parent. And how do parent treat the investment in ordinary shares, right? When they are also investment in preference shares. To start, it is advisable for you to self-study example 4 that is available in this channel. So you can check the link down my description below for your self-revision. Some important reminders before we begin. In order to be able to attempt this question, you should first also self-study example 1 at page 390 to page 393 at chapter 11 so that you have a better understanding of what I'm going to explain. And secondly is that to know the accounting treatment for the preference shares acquired as well as debentures acquired in the subsidiary and the issue on goodwill, you should also refer to the textbook again, which is textbook by Jane Laza, published in which is for 9th edition, published in 2018. That is company accounts, which is group accounts and financial reporting. Go to chapter 11. And today I have selected a question from that book, which is question 11.1 at page 419. And the name of the parent in that example is Handsome. And the query or the subsidiary is Pretty. So this is the question that I have already included here for our easy reference. So you have financial position, statement of financial position of Handsome and Pretty as at 31st of December year 5. 31st of December year 5 is actually the reporting date of the company, which is the current financial year end. And here you have some information that I have already highlighted. There are the information on the equity and liabilities of the both parent and subsidiaries, right? You can see here. And there are important information regarding what was the acquisition being made by the parent. Here the parent is Handsome. How do we know the parent is Handsome? Because Handsome is the one that purchased the shares in the subsidiary company. Here is going to be a subsidiary company, Pretty, because the acquisition is more than 50%. And in a simple indicator, the acquisition which is more than 50% is likely to give you a voting power, a majority. So basically that will give you the control. Right, so if you have those information, that information is here. So Handsome purchased 400,000 ordinary shares. So acquiring ordinary shares, I have put this underlined in blue. And preference shares, 50,000 preference shares in Pretty on 1st of January 2000 X3. So this 1st of January 2000 X3 is actually the date of acquisition for all ordinary shares that were acquired, which is 400,000. The preference shares, 50,000. And for your information, even though it is not stated here, there was an acquisition of the debenture or the loan stock that is given in the information in the statement of financial position. This one is the carrying value of the investment that have been recorded when parent acquired earlier And this is the separate financial statement of the parent, where you can see that there is a breakdown on what was the um, cost of investment for the ordinary shares, preference shares, and the loan stock. So loan stock that was acquired is 40,000. So we can use that information, and it was acquired. All of them were acquired on 1st of January for 450,000. This one is in the original question it was put 500,000. There was maybe some mistakes there, maybe some typo. But this one is the correct one is 550,000, because if you total up here, the ordinary shares, the cost of investment is 50, and for the preference shares, where you can see here, the cost of investment is 500 plus 50,000. Sorry, so it is 550. So I've made some correction to the original figure that was 500. So it should be 550,000. For the debentures, that was a separate cost of investment of 40,000, but this is not informed here because the information that you have down here was just referring to ordinary and preference shares, right? And on that date, the retained profit or the pre-acquisition reserve of Pretty was 42,000. And here is the date of acquisition. And this one is 31st of December, year 5, right? Which is after 3 years of acquisition. Then only you are going to prepare the consolidated statement of financial position after 3 years. Because 31st of December, year 3, you have not yet prepared or consolidated. 31st of December, year 4, no consolidation. And that will be done by 31st of December, X5. So you are required to prepare the consolidated statement of financial position as at 31st of December, X5, which is year 5. The fair value of the non-controlling interest here cannot be measured at fair value on the date of acquisition. What does this mean? This means that the non-controlling interest will be measured based on the proportionate share of the fair value of the net asset in the subsidiary company on the date of acquisition. So meaning that the non-controlling interest in the acquisition of ordinary shares will be based on the fair value of the net asset, and we're going to multiply that with the NCI shareholding. Okay, done with that. So this is the investment, and let us look at how do we calculate or do the first thing before we can start doing our statement of financial position. The consolidation itself is to do some workings. So let's do the workings together, right? Okay, so I have put a few steps here, where the first one is for you to determine the proportion of shares and debentures held in your investment made. So if you look here, right, you have the information. You need to make use of those information that you have. So I'm going to make it a little bit smaller here. Okay. Number one is that you're going to calculate how much is the percentage held by the parent, because H percentage means the percentage held by parent, right, or the holding company. So if you see here, the number of shares that were acquired, if you base on the information given here, number of shares acquired was 400,000, and the number of shares in the subsidiary company, I have put this blue box here, 600,000. So you will take 400 divided by 600,000, you will get the 2/3 to be the percentage that are the control. And therefore, because you have more than half, that is considered as a control. So meaning that the NCI has a percentage of, not percentage, a proportion of 1/3. And nothing belong to the debenture holder, because share capital, they are the shareholder, right? So I'm just putting one more extra column there. And then second one is the 5% preference shares that you acquired. So that was the 9% preference shares that you acquired. So if you look here in your statement, under the Pretty's column, which is the subsidiary column, you have 200, right? And that is the amount. You need to look at what is the unit. So 200,000 is what was available. You acquire for which is given here 50,000. So 50 divided by 200,000, that give you 25%, right? 25%. So you have 75%, the portion by NCI, percentage of share held by NCI in the preference shares. Next one is to look at the acquisition of the loan stock or debenture. That 10% loan stock, you acquire 40,000. And if you check your loan stock information in the statement of financial position of Preti, it is 100,000. So 100,000 here, meaning that it is RM 400,000, the amount, not the unit. There's no units here. 400,000 divided by 100,000. That will give you 40%. So nothing will relate to NCI because debenture holder are not shareholder. So non-controlling interest will only relate to shares that are an equity. So meaning that to preference shares, to ordinary shares, yeah. But NCI will not be applicable for items which are liability like loan capital and redeemable preference shares. So if let's say this is a 10% redeemable preference shares, it is also not having any non-controlling interest because those are all non-current liabilities. So the percentage held by the remaining debenture holder, which is not the parent company, is 60%. Okay, that was the first thing. The second thing that you need to do is you need to take note that now you need to go and calculate goodwill, right? So before you can calculate goodwill, you need to check that what to be done with our new accounting treatment for our investment in preference shares and loan capital. So my advice is for the second step, try to cancel off any investment in preference shares and debenture in subsidiary that you have made. In our case, yes, we do. And then recognize their goodwill, if any. So if you can see here, if I said to cancel off, what you need to do is you need to calculate goodwill if there is any for each of the acquisition of preference and ordinary shares. So let's look at what we have. So if you look for the preference shares, the consideration transfer for the preference shares, as I said, was 50,000. So you're going to put here just like what you calculate before, 50. And then you need to also calculate the non-controlling interest. So to calculate the non-controlling interest, okay, what you will do is the non-controlling interest is actually 75%, right? 75% from the number of, from the ordinary shares, sorry, from the preference shares in subsidiary, 200,000. So 75% from this 200,000. So therefore that will give you the NCI relating to the preference shares, right? The next stage is for you to total up this to get the so-called amount, which we'll have to compare later with the fair with the remaining preference shares. Let me just reveal this for you. It is 200,000. Next one is for you to look at how much is the preference shares in the subsidiary. So if you see here, you can see that the preference shares in subsidiary here was 200,000. If this two total is greater than 200,000, the carrying value of the preference shares in the subsidiary, that will give rise to goodwill. But here you can see that the total are exactly the same, meaning that if this is supposed to be A, these two are A, just like when we calculate the goodwill for ordinary shares. So this one would be B, right? So therefore, if that is the case, there are no goodwill. So the goodwill is 0. So no goodwill. So for this acquisition, no goodwill. If you come across this is higher, so that would be goodwill. So let me just give you some more explanation here. So I put some information here regarding the acquisition of preference shares. If you can check here. So these are some notes that I provide for you. There is usually no goodwill associated with the investment in debenture or loan stock. For goodwill, normally none, because of the debenture borrowings, and therefore there are no goodwill. For investment in preference shares, there may be goodwill involved. Maybe not, maybe yes. The difference between the carrying amount of the preference shares and the consideration price, which is this information that I have already put in my workings, consideration transferred plus the non-controlling interest, and then you go and deduct or compare with the carrying value. Should that be greater than the carrying value, then there will be a goodwill. If that is lower than the carrying value of the preference shares, there will be a bargain purchase. But in our case, it is exactly equal, sama, right? It is exactly equal. So equal means therefore there is going to be no goodwill or no bargain purchase. So for that reason, there is a goodwill. There isn't a goodwill. The next one is for you to look at the investment in your debenture, your loan stock. The same thing that you need to do is to find out what is the consideration transferred for the loan. So if you have checked what I mentioned earlier, it was 40,000. Go and check that and refer to the textbook, refer to the question yourself. Go and jot down what I've done here in your own textbook. Take the textbook and do it with me here. So it is 40,000. So you're going to put that 40,000 here. So the consideration transferred for the debenture or the investment in the debenture of the, sorry, it's here, the investment in the debenture of the subsidiary. So the consideration transfer, if you check, given here was 40. Yeah, it's 40,000. You invest 40,000 debenture, and that was for 40,000. So let me just reveal that. Okay, here, 40. Go and check. And then therefore, look at the carrying value of the debenture that you have. Right, it is 100. But what you need to do is you need to take that 100,000 here, and you need to multiply with the percentage of the amount acquired. Take the carrying amount and multiply with the amount acquired. Amount acquired is 40%, right? So the carrying amount here would be RM 100,000 times 40%. 40% is the amount acquired. So with that, you will get 40. If you can compare these two, you would see that again there is no goodwill, as what I have mentioned earlier in my explanation, that the acquisition of debenture will normally not involve any goodwill, right? So therefore you have the no goodwill there, so there is none, right? You are done with that. So when you are done with that, the next stage is to calculate another goodwill that you will maybe have a bargain purchase, or you may have perhaps also the goodwill, which is for the acquisition of your ordinary shares. So let's look at that part now. So for the acquisition of ordinary shares, the acquisition here, the consideration that you have already transferred much earlier is 500,000, and you are going to just do what you have done before, where you're going to put the consideration transferred in the workings for goodwill, and that was 500,000, and you're going to calculate the non-controlling interest, or look at what is the value of the non-controlling interest in the subsidiary. Here, what you're going to do is you're going to take 1/3. Before you can do that, okay, I will be revealing this later. Okay, number one is for you to do this. This is number one, right? For you to do, I put here A. This is now A, or step one. And then B is that you need to find out what are your fair value of net asset. Okay, A is this first one. Second one is to find fair value of net asset on available in the subsidiary company on the date of acquisition. Okay, so you need to go and look at what are the equity balances available in the subsidiary on the date shares were acquired. So in your case, you have the ordinary share capital, right? So if you look at the ordinary share capital, the balance in the ordinary share capital was 660,000 in the subsidiary company. We assume that throughout that 3 years, there are no changes to the share capital. So we assume that because no information was given. So you put that 660,000 here. The next one is that you should find out what is the reserve available on the date of acquisition. So reserve available on the date of acquisition. So here you have the retained profit given to be 42. So the retained profit is 42. Okay, 42,000. And actually there is no general reserve. This is just somehow, do not know why it is there. So there is no general reserve. So there is just a retained profit. How do I know there is no general reserve? Because no information at all regarding general reserve in this question. Next, the next thing to do is to total up the fair value of net assets. So if you total up, you will have 702. So what you will do is you will now calculate your non-controlling interest on the date of acquisition, where that would be taking the 1/3, which is the percentage held by the NCI, multiplied with the fair value of net asset on the date of acquisition. At the moment, this is the only thing that you have. Okay, this is your fair value of net asset. And therefore, it will give you a goodwill. The goodwill would be the goodwill would be 32,000 because 734 minus 702. And now you need to total up all goodwill that you have in case there are goodwill from acquisition of preference shares, there are goodwill from acquisition of also debenture. So if there is none, so this is the total goodwill, which is also 32,000. So the total goodwill is 32,000. So that means that you have already computed the first part of it. So let me just reveal to you the relevant consolidation journal entry that you should have done on the date of acquisition. For the acquisition of your preference shares, for the acquisition of preference shares, you need to go and do some consolidation entries where you are going to cancel off the investment in 8% preference shares in Preti against the non-controlling interest. So what is the journal entry? You can check your textbook, but I'm just trying to apply straight away here. Debit the preference shares, 200,000, the carrying value of the preference shares. Credit the investment because you acquire that preference shares for 50,000, not all, only how much was it? Only 25%, and therefore the remaining that was not acquired is 75%, right? So the one that was not acquired is the one held by the non-controlling interest. So the NCI was 150,000. NCI was 150,000. Right, next. Meaning that now it has you have already eliminated or cancelled off the investment in preference shares. The next one is to do the consolidation adjustment that involve the debenture, right? The cancellation for debenture now. For debenture, you need to debit the loan stock or debenture. If it's a debenture, it will be debenture for the amount that are being acquired. So what you will debit is just amount acquired, based on the amount acquired, which is based on percentage of amount acquired. Right? Percentage of amount acquired. Right? And then this one is done similar to what we have discussed earlier. This is done to cancel off the investment in 12% debenture. Investment in not 12%, it is 10%, right? 10%. There was some typo here. Just make it right straight away. Loan stock. Loan stock in pretty, right? And then what you will credit is that you will credit that to the cost of investment. You will not credit to NCI because NCI, as I say, only relates to shares that qualify as equity, right? Similar thing should be done if you are doing for redeemable preference shares. Next, the consolidation entry for the goodwill. I reveal everything. Right, so debit only shares 660,000. This is from the share capital balances. Debit retained profit. This one is the pre-acquisition balance, right? Pre-acquisition balance. Meaning that balance on on the day of acquisition. Balance on the day of acquisition. Remember, we acquire on 1st of January X3. And debit the goodwill on consolidation 32,000. So this is to record the goodwill. And just to show that goodwill only arise during acquisition of the so-called ordinary shares. Okay, then you have, this is the narration for what you have done. You credit your investment in Pretty and you credit NCI, and NCI is from here. So this is what you take from the working. So this is not required for you to do. I'm showing you so that you have a better idea of what you are doing.